Hello, fellow RoboCapitalists. Hope you're well. Let's go over a video from my good friend and global monetary expert. I think he is the foremost expert on this topic in the world, in my view. His name is Jeff Snyder. Most of you know him. There you go. Josh has got him on his wall there. But Jeff just is absolutely brilliant on this topic. And so when he says something like what we're seeing today is similar to what we saw in 2007, you need to listen. You need to not just listen, but you need to sit down, pay attention, and take notes, because Jeff doesn't say things using hyperbole. He's very, very careful with the words he uses. He's not like me. so, so let's get into this video. Just play a short clip here, and then we will come back and I'll kind of explain to you guys what he's talking about. And then I'm going to show you a chart that you can use to determine, how precarious things are getting. So Josh, if you can go ahead and just hit the play button there. And
you actually have to do that one.
Oh, I do. Okay.
To 2007, because as soon as you do, you bring up the 2008 crisis. Everybody thinks Lehman Brothers, Bear Stearns, all that. We're not saying that the 2008 monetary crisis is going to repeat, merely that we have to go back to that period because, as I said, that's the only comparable. The market, financial, money, and economic uncertainties, dangers, potential negatives, all of those things are as comparable today as they were back then, if for somewhat different reasons, although quite a few of them that are actually the same. Collateral. Either way, let's do some review about 2007 Eurodollar futures, and then we'll talk about what's going on right now that actually suggests that comparison.
Okay, so we'll stop right there and let's go back. And so you saw Jeff kind of making an attempt at humor there. And Jeff in real life is actually he's a really funny guy, but his family is fantastic. But so you saw him kind of cough and then say collateral. And I think this is what he was getting at through most of this video, because this is a big problem that we had during the GFC. And it is true that we had all these subprime loans and that a lot of them were going into default, and this was creating this systemic risk or this contagion effect throughout the banking system, because a lot of these banks had this garbage on their balance sheet. But if you guys watched my video yesterday, you remember that even at the height of the GFC and the real estate collapse, the mortgage default rate only went up to about 5.5%. Not that high. And it started at about 1.52%. So up maybe 4%. What most people remember is what they believe happened was that it went from, let's say, 2% up to like 50%. That's how dramatic it was. But it really wasn't a huge deal if it was an isolated instance. But unfortunately, it wasn't. And what it did is it exposed the fragility of the global monetary system. Why? Because the global monetary system, the Eurodollar market, if you will, had expanded to the point where it was not only a reserveless system. I was about to say fractional reserve, but it wasn't even a reserveless system, or it wasn't even a fractional reserve system, because it didn't have reserves. It was reserveless and cashless, right? They were quite literally creating money out of thin air with nothing backing it at all, not even reserves. And the way they did this is they had all of these loans that were collateral. They were using balance sheet management through collateral instruments such as T-bills. But back then, they're also doing this with mortgage-backed securities that were viewed in a very similar light. And they weren't just creating money out of thin air. They were also creating collateral out of thin air to create the money in the first place. And they were creating this money by loaning it into existence. So you say, George, how on earth can they create collateral? That doesn't make any sense. They don't have the power to create a treasury or a mortgage-backed security. Correct, but they can just rehypothecate it. They can just use one piece of collateral for collateral on 20 different loans. And this is exactly what they did. And by their calculations, there was no problem here because the collateral was as good as gold. I'm going to use that term. But what happens if there's a chink in the armor of the collateral, then all of a sudden the house of cards comes crashing down. And the big problem there is that there was no collateral to replace the mortgage-backed securities. So this is why Jeff always says that the GFC was a global monetary crisis. It wasn't really a global financial crisis. And that they couldn't continue to create the amount of dollars necessary to facilitate the global economy because of a lack of pristine collateral, because of what happened starting at a very low level, a micro level, as far as these mortgages not being paid back, and therefore the market just saying, oh my gosh, these mortgage-backed securities weren't what we thought they were. Prices of homes can actually go down. And although you didn't have much of a move up in the default rate, just that 4 percentage points, let's call it, sent this ripple effect through the entire global monetary system where it just basically froze. And the problem there is that this global monetary system was so fragile and it didn't have any other collateral as a backup. So as an example, if they would have been using other forms of collateral that were pristine and that had the confidence of the market players that were involved in the equation, then they could have just shifted from mortgage-backed securities to XYZ. And what they did is they tried to switch to T-bills, but there just wasn't enough of them. So then the Fed had to come in with quantitative easing. They're just kind of plugging the holes. But if we were running on all 8 cylinders, we went down to running on about 2 cylinders. And the Fed just came in with QE, really didn't solve the problem at all. In fact, probably just made it worse. But at least that got the engine kind of sputtering to the point where it was running on, let's say, 4 cylinders. But they never fixed the problem. And that is this monetary system is so dependent upon collateral. It's even more dependent now, although there's arguably less when you consider rehypothecation. Why? Due to the perceived counterparty risk. So that's another thing. Going back prior to the GFC, there was like 0 counterparty risk or perceived, right? And that's why they were rehypothecating this collateral over and over and over. In fact, many of these loans Jeff talks about, many of this money creation outside of the United States that was reserveless didn't even have collateral. They're like, collateral? Who cares? We don't need any collateral. It's nonsense. But then all of a sudden, they have this oh crap moment. And not only do they need collateral, but one of the biggest sources of collateral is no longer there. So what's my point? And what's Jeff's point? He says, what you have to do is you have to look at a couple charts, and that will tell you if the global monetary system has sufficient collateral in order to operate, not even at 8 cylinders, but even the 4 cylinders that it's been kind of sputtering along with since the GFC. And one indicator is the 1-month T-bill. So let's go ahead and look at the yield on the 1-month T-bill.
You're going to have to reshare your screen.
Oh, really? Okay. So I stop. Sorry, guys. Share. Okay, there we go. That should do it. All right, so let's look at the yield on the 1-month T-bill. I'll go ahead and refresh. And we've got 3.5. 3.5. Why is this important? And also, let's look at what it's done over the last 3 months. It's pretty much gone straight down. And especially over the last month, you can see it just plummet in yield. But what has happened over the past month is the Fed has gotten hawkish, and they said that they're going to continue to raise rates. And as a matter of fact, next week, the market expects them to raise rates another 50 basis points from 3.75 up to 4.25. Okay, well, the Fed is raising rates next week. Wouldn't that make all the rates in the yield curve go up? Absolutely not. We see the 1-month T-bill doing the exact opposite. Now, that's not to say that it won't bump up to maybe, 3.6, maybe even 3.7 when the Fed does raise rates. But what's important to observe is the delta between reverse repo, which is the kind of benchmark overnight rate that the Fed uses to put a floor, or try to put a floor on overnight rates throughout the entire economy, and this 1-month T-bill. So just as a reminder, reverse repo right now is 3.8. And that's going up to most likely 4.3, because they're taking from it was right now it's 5 basis points above the low end of this range. So assuming that low end of the range goes from 3.75 up to 4.25, add another 5 basis points, you get 4.3. And so let's just assume for a moment that the 1 month goes up to 3.7. Well, now all of a sudden you're 60 basis points under what the Fed uses to try to put a floor on interest rates at the short end of the curve. And you say, George, that's not exactly, well, okay, fine, overnight rate, which effectively they're trying to put a floor on the short end as well. Although the short end a lot of times trades under Fed funds and under reverse repo. But what we have to take note of is the degree to which it is happening, right? So normally, let's say you got a 5 basis point spread where the 1 month trades at 5 basis points under Fed funds, not reverse repo. And but now we're talking about 75 basis points or 70 basis points. And I mean, this is a staggering number. So what Jeff, the conclusion he comes to, and the main point of his video, is this is the marketplace telling you that they would much, 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 much rather have 1 month T-bills to the tune of 60 or 70 basis points than actually just park their cash, quote unquote, at the Fed and get a complete risk-free rate of 3.8%. Why is that? Because they need collateral. They need collateral to manage their balance sheet. This is the oil, if you will. It's almost basically the gasoline that the engine of the global monetary system needs. And it can't run out of gas, or it just completely stops working. And the gas is collateral. So when you see the gas getting very, very low, then that's when you would assume, because there's so much demand, that the price would increase. And this is reflected by the yield going down to such a significant degree under reverse repo. That's really the main thrust of what Jeff is saying. So then you have to ask the question, well, why would the market need this much collateral to the point where they're willing to bid up the price to such a massive level? The answer there is because you are most likely seeing the collateral multiplier decrease. So let's just say that you've got these 1 month T-bills that are out there circulating in the global economy used for balance sheet management. And let's just say, for the sake of saying, that there's 100 of these, obviously a lot more than that, but just to keep it simple, there's 100. And let's just say that they are still rehypothecating them, which they are, maybe not to the same degree, but they're still doing it. And let's just say that they're rehypothecating them twice. So now there effectively is 200 of these pieces of collateral instead of 100. Well, if you get increased perceived counterparty risk, then obviously they're not going to be willing to rehypothecate those to the same degree. So like, whoa, nope, no more rehypothecation. We're only willing to take a T-bill that we know hasn't been rehypothecated as an example. So therefore, the collateral multiplier goes down to 1 from 2, and the amount of collateral in the system goes from basically 2 all the way back down to 1. And if it goes to 1, then people scramble around. They're willing to pay a much higher price for that collateral. See the yield go down, price go up. So there's a lot of variables here, because if I had Joseph Wang on, who's another good friend of mine, who's just as smart as Snyder, although Snyder really gets into the weeds with different types of topics. But I think Joseph would say, okay, well, this is true. It is very, historically significant as far as the delta of the yield between the 1 month and what we'll most likely see with reverse repo next week when the Fed raises rates. But there could be some other things that would explain this, such as overseas hedge funds, pension funds that don't have access to the Fed's balance sheet. Therefore, they can't park their cash in reverse repo. But yet the demand for these 1 month treasuries is still strong by them, because they keep this on their balance sheet, and the yen is depreciating against the dollar, and they're still getting a 1 month rate of 3.5% annualized. That's a smoking deal for a Japanese pension fund. So they don't really care about reverse repo. All they care about is this 3.5% being so much higher than a 1 month JGB, if that's a thing. And it serves multiple purposes, right? So that's why you could see such demand at the front end of the curve. It's not just domestic demand that we've got to think about. And that is absolutely true. So I'm not saying, and I don't think Jeff would say, that the only reason that you see a discrepancy is because of a collateral issue, or what I would say is additional counterparty risk. But it is definitely one of the strongest reasons. And obviously, it's something that we need to pay attention to when we're trying to think through what will most likely happen in 2023 in terms of the global economy and a potential recession.
As the 10 and 30 year are both below the 1 month and RRP and significantly under, as the Fed is going to raise rates again, is that more of a collateral issue, or do you think that's a result of speculators?
No, that's not a collateral issue. That's an issue of really, in my opinion, the market hedging. So they've got a long portfolio, let's say, of stocks, and like, okay, we really need to hedge this. How do we want to do it? Okay, let's go ahead and buy the long end of the curve, because if our stocks go down, that'll most likely be in an environment where the Fed is having to lower rates. And if they're having to lower rates to that degree, if we buy something at the long end of the curve, we're going to get more bang for our buck when those interest rates actually fall and the price goes up, because there's more duration there.
Okay.
So I think that's the big reason. I mean, usually you would have, if you're just a normal investor and you're just thinking about a yield, the reason you buy the long end of the curve is so you're just kind of trying to predict what long-term inflation plus growth is going to be. It goes back to Irving Fisher, I believe, was the first economist who expressed the idea, and I think it's kind of expressed through the Fisher equation. My memory serves me right. But now you've got, to your point, Josh, you've got speculators out there that are just, they don't care about future growth. They don't care about future inflation expectations. They're just like, hey, we're just buying this because, well, I guess they would be thinking about future inflation expectations and growth, because that's basically a bet against future growth and inflation. And that brings down the overall yield. But then, so you've got that component of it. You've got the normal investors, you've got the speculators, and then you've got the other financial institutions that are using that long end of the curve to hedge the rest of their book. And I'm sure you've got a variety of other reasons in there that I haven't yet mentioned. So the main point is the supply demand dynamics, or at least especially the demand dynamics, and what motivates demand is much, much, much different at the front end of the curve than the long end of the curve. And it's almost like they're two completely separate bond markets. All right, guys, make sure that we're paying attention to this. I can't suggest Jeff's channel enough. It's Eurodollar University. And make sure that you're paying attention to the reverse repo rates and what's happening between the delta between the 1 month and wherever reverse repo is next week when the Fed raises rates. As always, enjoy the rest of your afternoon. Stand up for freedom, liberty, free market capitalism. We'll see you in the next video.